Welcome to Prep Pass. Here are 25 real property and casualty insurance license practice questions with answers for 2026. Read each question, then try to answer before the 5-second timer runs out. For the full free practice test, just search preppass.org. Let's begin. Question 1. An HO3 policy provides what kind of peril coverage on the dwelling, coverage A, and on personal property, coverage C? A. Named perils on both the dwelling and personal property. B. Open perils on both the dwelling and personal property. C. Open perils on the dwelling and named perils on personal property. D. Named perils on the dwelling and open perils on personal property. The correct answer is C. The HO3 special form is the most widely sold homeowners policy precisely because it gives the dwelling and other structures open peril, all risk, protection, meaning any cause of loss is covered unless specifically excluded, while personal property is written on a named peril basis covering only the 16 listed perils such as fire, lightning, windstorm, theft, and vandalism. Question 2. A tenant rents an apartment and wants to insure her own belongings and protect herself against liability claims by guests. Which homeowners form is designed for her? A. HO2. B. HO4. C. HO6. D. HO8. The correct answer is B. The HO4, often called the renter's or tenant's form, is built specifically for someone who does not own the building. It provides named peril coverage on personal property, coverage C, additional living expense, coverage D, personal liability, coverage E, and medical payments to others, coverage F, but does not include coverage A for the dwelling itself, which remains the landlord's responsibility. Question 3. Which homeowners form provides open peril, all risk, coverage on both the dwelling and personal property? A. HO2. B. HO3. C. HO4. D. HO5. The correct answer is D. The HO5 comprehensive form is the broadest unendorsed homeowners contract sold in the United States. It upgrades the HO3 by extending open peril protection from the dwelling to personal property as well, so a loss to either is covered unless an exclusion applies. It carries a higher premium and tighter underwriting because of that broader trigger. Question 4. Which homeowner's form is intended for a condominium unit owner and includes a loss assessment coverage for assessments levied by the condo association? A. HO6. B. HO3. C. HO4. D. HO8. The correct answer is A. The HO6 is the condo unit owner's form. It covers interior building items the owner is responsible for, cabinets, flooring, fixtures, personal property, additional living expense, liability, and medical payments. A built-in loss assessment coverage responds when the homeowners association assesses unit owners for a covered loss to common property, subject to the policy's assessment limit. Question 5. An owner of a 110-year-old Victorian in San Francisco cannot find a standard HO3 policy because the replacement cost exceeds the market value by a wide margin. Which homeowner's form is designed for older homes and settles dwelling losses on an ACV, actual cash value, basis? A. HO2. B. HO5. C. HO8. D. HO4. The correct answer is C. The HO8 modified coverage form is designed for older or historic homes whose replacement cost greatly exceeds market value. Dwelling losses are paid on an actual cash value basis, or repair cost basis using common materials and methods, instead of full replacement cost, making coverage available where an HO3 would not be affordable or insurable. Question 6. On a standard HO3 policy, coverage B, other structures, is typically provided as an automatic additional amount equal to what percentage of coverage A, dwelling? A. 5%. B. 10%. C. 20%. D. 50%. The correct answer is B. Other structures, coverage B, is automatically provided at 10% of coverage A on the standard ISO HO3. This is an additional amount of insurance, not a sublimit, and pays for detached garages, sheds, fences, and similar structures separated from the dwelling by clear space. Higher coverage B can be purchased by endorsement when needed. Question 7. On a standard owner-occupied HO3, what is the customary built-in limit for coverage C, personal property, as a percentage of coverage A? At 10%. B. 25%. C. 40%. D. 50%. The correct answer is D. Personal property, coverage C, is automatically set at 50% of coverage A on the standard owner-occupied HO3. The insured may increase this percentage by endorsement if the home contains an unusually large amount of contents, but the 50% default reflects typical household exposure. Coverage C also extends worldwide, with limited coverage off-premises. Question 8. An insured family's home becomes uninhabitable after a covered fire and they must rent a similar apartment while repairs are completed. Which Section 1 coverage pays for this additional living expense? A. Coverage D, loss of use. B. Coverage E, personal liability. C. Coverage C, personal property. D. Coverage B, other structures. The correct answer is A. Coverage D, loss of use, pays additional living expense, ALE, above the family's normal cost of living when a covered Section 1 peril makes the residence uninhabitable. It covers reasonable lodging, meals, and other increases until the home is repaired or until the family permanently relocates, subject to the policy's time and dollar limits. Question 9. A visitor slips on the insured's icy front step and incurs a $1,800 ER bill. The insured was not negligent. Under a standard HO3 with $1,000 medical payments to others, how does the policy respond? A. It pays nothing because the insured was not negligent. B. It pays the entire $1,800 under coverage E, personal liability. C. It pays up to $1,000 under coverage F regardless of fault. D. It pays only after the visitor exhausts her own health insurance. The correct answer is C. Coverage F, medical payments to others, is a no-fault Section 2 coverage that pays reasonable medical expenses for guests injured on the insured premises up to the listed limit, typically $1,000 to $5,000. The insured's legal liability is irrelevant. The coverage is meant to head off disputes and small lawsuits. Larger awards based on negligence fall under coverage E. Question 10. What is the standard minimum limit for coverage E, personal liability, on an ISO homeowners policy? A. $50,000. B. $100,000. C. $300,000. D. $500,000. The correct answer is B. The ISO homeowners forms list $100,000 per occurrence as the standard Section 2 personal liability limit, although insureds routinely buy higher limits such as $300,000 or $500,000, or purchase an umbrella policy to sit above the homeowners. Coverage E pays sums the insured is legally obligated to pay as damages because of bodily injury or property damage covered by the policy. Question 11. Under California Insurance Code Section 10081, When must an insurer that writes residential property insurance offer earthquake coverage to the applicant or insured? A. Only when the property is located in a high-hazard fault zone. B. Only after the first claim is paid. C. Once every 5 years. D. At the time the policy is first issued and again every other renewal. The correct answer is D. California Insurance Code Section 10081 requires every insurer that writes residential property insurance in California to offer earthquake coverage at the time the policy is first issued, and again at least once every other renewal, i.e., every 2 years. Most insurers satisfy the requirement by referring the buyer to the California Earthquake Authority, CEA, for a separate companion policy. Question 12. After the governor declares a state of emergency for a wildfire, California Insurance Code Section 675.1 prohibits an insurer from canceling or non-renewing a homeowner's policy for property in or near the burn area for how long? A. 1 year from the date of the declared emergency. B. A 60 days from the date of the declared emergency. C. 180 days from the date of the declared emergency. D. 3 years from the date of the declared emergency. The correct answer is A. California Insurance Code Section 675.1 imposes a 1-year moratorium following a declared wildfire emergency. During that period, an insurer may not cancel or non-renew a residential property policy solely because the property is located within the perimeter or zip codes adjacent to the disaster, even if the insured did not suffer a direct loss. The protection applies to policies in force on the date of the declaration. Question 13. A heavy rainstorm causes a nearby river to overtop its banks, and floodwater enters the insured's basement, ruining the carpet and furnace. Under an unendorsed HO3, how is this loss handled? A. Covered in full as a windstorm peril. B. Covered up to coverage C limit only. C. Excluded because flood is not a covered peril, separate NFIP coverage is needed. D. Covered under coverage D as additional living expense. The correct answer is C. Flood, defined as surface water, waves, tidal water, overflow of a body of water, or spray from any of these, is excluded from every standard ISO homeowners form. Coverage requires a separate flood policy, almost always written through the National Flood Insurance Program, NFIP, or a private flood insurer. The HO3 also excludes earth movement, sewer backup, unless endorsed, war, nuclear hazard, and intentional acts. Question 14. An HO3 dwelling has a replacement cost of $500,000. The insured carries only $300,000 of coverage A. After a $50,000 partial fire loss, how does the loss settlement provision generally apply? A. Insurer pays the full $50,000 because the loss is below the policy limit. B. Insurer pays a reduced amount because the insured failed to carry at least 80% of replacement cost, $400,000. C. Insurer pays only actual cash value because the policy is invalid. D. Insurer pays nothing because the insured was underinsured. The correct answer is B. The HO3 loss settlement clause pays replacement cost on the dwelling only if the insured carries at least 80% of the full replacement cost at the time of loss. Here 80% of $500,000 is $400,000, but the limit is only $300,000, so the insurer pays the greater of actual cash value or the proportion, 300,000/400,000 equals 75% of the loss, which results in a reduced settlement on the $50,000 loss. Question 15. Without a replacement cost endorsement, how is a covered loss to personal property, coverage C, settled on a standard HO3? A. Actual cash value, ACV, i.e., replacement cost minus depreciation. B. Full replacement cost in every case. C. Stated value scheduled in the declarations. D. A market value of similar used items. The correct answer is A. By default, the HO3 settles coverage C losses on an actual cash value, ACV, basis, the replacement cost of the item minus depreciation for age and wear. A common optional endorsement, sometimes called personal property replacement cost, upgrades the settlement to full replacement cost, no depreciation, if the insured actually replaces the item within a stated time. Question 16. Standard homeowners forms place special internal sublimits on certain classes of personal property. Which of the following is typically subject to such a sublimit? A. Clothing. B. Kitchen appliances. C. Living room furniture. D. Jewelry, watches, and furs lost by theft. The correct answer is D. The standard HO forms cap loss by theft on jewelry, watches, furs, and precious stones at a low special limit, commonly $1,500. Similar special limits apply to firearms theft, silverware theft, money, securities, and certain business property. Insureds who own valuable items above the sublimit should add a scheduled personal property endorsement, inland marine floater, to provide full coverage and avoid these sublimits. Question 17. A client owns a $20,000 wedding ring she wants fully insured against accidental loss, including mysterious disappearance. Which device is most appropriate? A. Increase the coverage C limit by 10%. B. Add a scheduled personal property endorsement listing the ring with an appraised value. C. Rely on the $1,500 jewelry theft special limit. D. Buy a separate flood insurance policy. The correct answer is B. Adding a scheduled personal property endorsement, also called a personal articles floater, is the right answer. It lists the item individually with an appraised value, gives broad open peril coverage including mysterious disappearance, and is not subject to the deductible or the homeowner's $1,500 jewelry theft sublimit. Simply raising coverage C would not eliminate the sublimit or extend the perils. Question 18. Under the standard mortgage clause in a homeowner's policy, how much advance written notice must the insurer give the mortgagee before a cancellation takes effect? A. 30 days. B. 20 days. C. 10 days. D. 5 days. The correct answer is C. The standard mortgage clause requires the insurer to give the mortgagee at least 10 days written notice before cancellation for non-payment of premium, and longer notice, often 30 days, for other reasons. The clause also protects the mortgagee's interest even if the insured's own claim would be denied because of the insured's act or neglect, and gives the mortgagee a right to pay the premium and continue coverage. Question 19. 6 months after the insured's HO3 takes effect, the insurer files a broadened policy form with the state that adds coverage for an additional peril at no extra premium. How does the liberalization clause apply to the insured's existing policy? A. The broader coverage applies automatically to the existing policy. B. The insured must request an endorsement to obtain the new coverage. C. The new coverage applies only at the next renewal. D. The new coverage applies only if the insured pays an additional premium. The correct answer is A. The liberalization clause provides that if the insurer broadens a form during the policy period, or within a stated window before the policy started, without an additional premium, the broader coverage applies automatically to the existing policy. This protects the insured from having to wait for renewal to enjoy the improvement and avoids cumbersome endorsement procedures. Question 20. Which statement best describes the California Earthquake Authority, CEA? A federal agency that pays earthquake losses. B. A privately funded, publicly managed entity that issues earthquake policies sold through participating insurers. C. A reinsurer that pays only commercial property earthquake claims. D. An association that pays admitted insurer insolvency claims. The correct answer is B. The CEA is a privately funded but publicly managed entity created by the California legislature in 1996. Participating residential property insurers offer CEA earthquake policies as the companion coverage required under Section 10081's mandatory offer. The participating insurer collects the premium and issues a separate CEA policy, while CEA pays the earthquake losses out of its capital and reinsurance. Question 21. What is the purpose of an inflation guard endorsement on a homeowner's policy? A. It pays the cost of building code upgrades after a loss. B. It lowers the premium each year. C. It automatically increases the coverage A limit during the policy term to keep up with construction cost inflation. D. It pays additional living expense indefinitely. The correct answer is C. An inflation guard endorsement automatically increases the dwelling limit by a stated percentage, often prorated each quarter, during the policy term so that coverage A keeps pace with rising construction costs. This helps the insured stay above the 80% coinsurance threshold and avoid being underinsured at the time of a loss. Code upgrade costs are handled by a separate ordinance or law coverage. Question 22. An insured's condominium association sustains a covered fire loss to the common area roof. Damage exceeds the association's master policy limit by $15,000, and each unit owner is assessed a share. Which HO6 feature responds to the insured's share of that assessment? A. Coverage B. Other structures. B. Coverage C. Personal property. C. Coverage F. Medical payments. D. Loss assessment coverage. The correct answer is D. The HO6 includes a built-in loss assessment coverage, often $1,000 with the option to increase, that pays the unit owner's share of a special assessment levied by the condominium association for direct loss to common property caused by a covered peril, subject to the policy's loss assessment limit. The other listed coverages address different exposures. Question 23. Which of the following claims would be excluded under Section 2 Coverage E of a standard HO3? A. Bodily injury to a customer of the insured's at-home daycare business. B. Bodily injury to a guest who slips on the insured's icy walkway. C. Property damage caused by the insured's child throwing a baseball through a neighbor's window. D. Bodily injury to a visiting plumber bitten by the insured's dog. The correct answer is A. Section 2 Coverage E excludes bodily injury and property damage arising out of business activities conducted by the insured, including a home-based daycare or any other for-profit venture. The insured would need a separate commercial general liability or in-home business endorsement. The other choices involve typical personal liability exposures that the standard form covers. Question 24. An insured's college-age son living away at school has personal property stolen from his dorm room. Under the standard HO3, how is this covered? A. Not covered because the property is off the resident's premises. B. Covered up to a percentage of coverage C, commonly 10%, because the student qualifies as an insured residing temporarily off premises. C. Covered only up to the coverage F medical payments limit. D. Covered only if a scheduled personal property endorsement was added. The correct answer is B. A full-time student who is a resident relative of the insured and whose absence from the household is temporary qualifies as an insured under the homeowner's definition of insured. The student's personal property at school is covered, generally up to 10% of coverage C or $1,000, whichever is greater. Limits vary by edition. All standard exclusions and coverage C sublimits still apply. Question 25. Within how many days after the insured submits a sworn proof of loss does the standard fire policy, incorporated into California residential property policies, generally require the insurer to pay an undisputed loss? A. 120 days. B. 90 days. C. 60 days. D. 30 days. The correct answer is C. Under the California Standard Form Fire Insurance Policy, the framework incorporated into residential property policies, the insurer must pay the amount of an undisputed loss within 60 days after receiving the insured's sworn proof of loss and reaching agreement with the insured, or a final judgment is rendered. Other claim handling deadlines come from the Fair Claims Settlement Practices regulations. That's all 25 questions. Want the full insurance practice test with hundreds of questions, completely free? Just search preppass.org. Good luck on your exam.